Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, I want to talk a little bit about portfolio allocation and different models with their historic returns, just because I see a lot of people going all 100% one way, 100% a different way, which is fine, but let's have a little bit of nuanced conversation here. I know that's kind of crazy on social media or on YouTube where you kind of find the golden middle, but we'll do that here in this video today. So what I wanted to share with you was a pretty interesting article that Vanguard just came out with. It's basically talking about their allocation models. So before I get into this entire study, I actually just want to show you where they're getting these stats from because that's important. So very quickly, they're going to use certain indices. So for the U.S. stock market returns right here, they use the Standard & Poor's 90 from 1926 to 1957, and then after that, they just use the S&P 500. For the bond market returns that we're going to talk about, they use the S&P High Grade Corporate Index from 1926 to 1968, and then they switch to the Solomon High Grade Index Fund, or Index from 1969 to 1972, and then after that, the Barclays U.S. Long Credit AA Index thereafter. And then for the U.S. short-term reserves, they use the Botson U.S. 30-day Treasury Bill Index from 1926 to 1977, and then the FTSE 3-month U.S. Treasury Bill Index after that. So let's start at the top. So how do you choose how much you want to invest in stocks or bonds? So these models are just basically used as guidelines with different goals-based investment strategies. I highlighted here in purple and also in yellow that there is no right or wrong model. So it's important to find out what fits your goals and risk tolerance. So before I get into this, the reason personal finance and investing is not controversial, but there's a lot of different takes is because a lot of people are at different points in their lives. Some people are trying to accumulate wealth, other people are trying to preserve it, other people are older, other people are younger, and then other people have a higher or lower risk tolerance than others. So that's why I think it's important to actually take a look at this video and break all of this down. So if we look at an income portfolio, this has typically been reserved for lower risk, typically older people. They have minimal risk and they have a short to mid-range investment time horizon. This is not something that I would recommend for people that are starting in their 20s or even 30s at this point, actually even 40s, but we'll get into that later in this video. So if we look at a 100% bond portfolio, you can look at all of these historical risk returns from 1926 to 2021. That's basically what this entire study was modeled after. And then I also broke all of this down into a spreadsheet here that we'll be talking about in the second half of this video. So let's fly through these real quick. So 100% bonds, you're getting an average annual return of 6.3%. The best year was 1982. It was 45.5%. The worst year was 1969. It was negative 8.1%. And out of 96 years of tracking this, there was 20 with a loss. Now, if we move into 20% stocks, 80% bonds, you can see all the statistics here. The average annual return was 7.5%. Best year was 40.7. Worst year was negative 10.1. And the number of years with the loss was 16 out of 96. If you go to 30-70, we're at 8.1%. The best year was 38.3. The worst year was negative 14.2. And they had 18 years out of 96 with the loss. And now we're moving into what we call a balanced portfolio. So typically, when you talk to a traditional financial advisor, they want to get you into a 60-40 portfolio, 60% stocks, 40% bonds, obviously depending on your age. Some people use the 120 rule. You can take the number 120, subtract your age from it, and that's the amount you should be in equities. So if you take 120, say you're 40 years old, you should be in an 80-20 portfolio. If you want to be more conservative, some people take it off 110, some even take it off 100. Makes sense? So if we go back to this balanced portfolio, this is basically investing in both stocks and bonds to reduce potential volatility. Typically, it's almost like an inverse relationship and also has a lot to do with interest rates. But investors that are seeking and comfortable tolerating short-term price fluctuations and they're willing to tolerate moderate growth and they have a mid to long-range time horizon. This will typically be for people that are probably in their, I'd say 30 to 50s. Actually, not even 30s. I'd say 40s to 50s, and then we'll get into growth later. So if we look at a portfolio that was 40% stocks, 60% bonds, you can see the average annual return was 8.7. Best year was 35.9. The worst year was 18.4, and it had 19 out of 96 years with a loss. If we look at 50-50, literally 50% stocks, 50% bonds, you can see that the average annual return is now increasing. We're at 9.3%. The best year was 33.5. The worst year was negative 22.5. And we had 20 years out of 96 with a loss. Now, here's the golden ticket, the one that I just talked about, the 60-40 portfolio, which has absolutely gotten crushed in 2022, by the way. 2022 is one of the worst years in history for the 60-40 portfolio, and that's why we're going through these exercises and going through these portfolio creation videos that I create. So historical risk and return has been 9.9% average annual return. Its best year was in 1933, which is 36.7%. Its worst year was in 1931. Actually, 2022 is very close to this, but 1931 was negative 26.6, and years with the loss starts to creep up at 22 out of 96. So now this is where we move into the growth portion of the video, or the portfolio, if you will. So this is basically consisting mostly of stocks expected to appreciate, taking into account long-term potential and potentially large short-term price fluctuations, aka high risk, high reward, higher risk, hopefully higher return. So an investor seeking this portfolio has a high risk tolerance and a long-term investment time horizon. These are typically people that are starting to invest. These are people that are in their 20s, 30s, 40s, and then you start to kind of go into balanced, and as you get older, you kind of typically transition into income, which we talked about in the very beginning of this video. So let's check out a 70-30 stock portfolio. So its average annual return is a staggering 10.5%. This is very good. Its best year was 41.1%. Its worst year was negative 30%. You can see the years with a loss is starting to creep up into the low 20s. If we go to 80-20, we have an 11.1% return. Its best year was 45.4%. Its worst year was negative 34.9%. And the years with the loss was 24 out of 96. And then here's where a lot of people watching this video are at. They may be younger. They may be in 100% stocks. There's nothing wrong with this, but you have to be able to stomach the risk with this that comes with it. So 12.3% average annual return, which is crazy in my opinion. That's very high. Its best year was 54.2%. Its worst year was negative 43.1%. And then years with the loss was 25 out of 96. So before we get into the second half of this video, where I break all of this down in a spreadsheet and give you some more easily visualized metrics, let's get into today's sponsor, Policygenius. If you have a family, you know how much your loved ones depend on you. In a worst case scenario, you wouldn't want them to worry about money. A good life insurance plan can give you peace of mind that if something happens to you, your family will have a safety net to cover mortgage payments, college costs, or other expenses so they can get back on their feet and focus what's most important. Life insurance through your workplace may not be enough protection for your family's needs, and it won't follow you if you leave your job. Let me tell you from personal experience, it is super satisfying to check life insurance off your to-do list, just like my wife and I were able to do with Policygenius. Policygenius was built to modernize the life insurance industry. Their technology makes it easy to compare life insurance quotes from America's top insurers in just a few clicks to find your lowest price. With Policygenius, you can find life insurance policies that start at just $25 per month for $1 million of coverage. Some options offer coverage in as little as a week and avoid unnecessary medical exams. Their licensed agents work for you, not the insurance companies. That means they don't have an incentive to recommend one insurer over another, so you can trust their guidance. Policygenius is for parents, caregivers, and anyone else who has people who depend on them. They simplify the process of getting life insurance so you can protect the people you love. There are no added fees, and your personal details are private. No wonder they have thousands of 5-star reviews on Google and Trustpilot. Your loved ones deserve a financial safety net. You deserve a smarter way to find and buy it. Head to policygenius.com/whiteboardfinance or click the link in the description to get your free life insurance quotes and see how much you can save. Okay, thank you for sitting through that. It helps fund the costs of running this channel. So I put this together after I looked at that article. This is just making it very easy to visualize all those different pies that we just looked at. So this is not me recreating some price models or showing you what the dollar amount appreciation would be at the end of 96 years. But this is pretty interesting just to see how this all kind of makes sense when you really break it down. So I basically started here from perceived least riskiest, that's actually hard to say. Perceived least riskiest. Try and say that 3 times fast. Perceived least riskiest. So we start with 100% bonds and end all the way down here with 100% stocks. And this actually just makes sense. I didn't sort these at all. This is just going from 20/80, 30/70, 40/60, 50/50, all the way down. And you can see here the average annual return just increases with the amount of allocation to equities, to stocks. So you can see here that it's almost double. If we're 100% bonds over 96 years, you're making average annual return of 6.3. If you're 100% stocks, you're making average annual return of 12.3, literally almost double. However, if you look at the best year versus the best year here, they're not that far off, which is pretty crazy. If you look at 100% bonds, that was 45.5%. If you look at the 80/20 stocks and bonds, it's actually underperformed that in terms of best year performance. But this is not a metric that I would base my portfolio on. Average annual return is the metric that you really want to look at, depending on how much you can stomach. So if you look at the worst year, 100% bonds was actually in the single digits. It was actually the worst year out of 96 years. If you have $100,000 in a portfolio, you're losing $8,100 of that, okay, in 1 year. Now take a look at that on the contrary if you go with 100% stocks. If you have $100,000 in a portfolio, you're losing $43,100 in 1 year. Can most of you stomach this? Well, so to put things into perspective, if you look at the great financial crisis of '08, or if you look at COVID in March 2020, we're closer to that -43 than the -8. So just use that as kind of like a metric in your brain to see if you'd be able to deal with that emotionally. Now, if you look at the years with a loss, the smallest number is actually the 20% stocks, 80% bonds, 16 out of 96 years, which is 16.67%. And if you look at the highest, and the reason these are all highlighted in yellow is because these are the highest numbers. Highest losses, highest annual return, best year, years with the loss, et cetera, et cetera. And if you look at the 100% stocks, we're at 26% out of the last 96 years. And obviously this should go without saying, but future results or past performance shouldn't indicate future results. It can't. No one has a crystal ball, right? We can go through the heat death of the universe and none of this matters, right? So what I'm trying to say is you can just use this as a track record or as a historical performance to get an idea of what you think you would be interested in terms of constructing your portfolio. So the smallest one on record was 20/80, highest was 100, and then you can see the percentages here out of the last 96 years, percentage of years with a loss. So if you're going into like 80/20 stocks and bonds or 100% stocks and bonds, 1/4 of the time, 1 out of every 4 years, obviously you can't look at it. You can't take that, what I'm about to say, at face value, but out of these 96 years, 1/4 of them were losses, if that makes sense. So hopefully you got some information or gleaned some information out of this. This is pretty self-explanatory, but it's nice to see the numbers backing this up. As investors, we are compensated for the amount of risk we take on, okay? So if you're investing in a savings account, you should be earning money on that, and that should be an almost guaranteed rate of return unless there is a bank run or something like that. Now, if you're investing in a startup, you should expect asymmetric returns because you're investing in something that's been historically incredibly risky, right? It's hard to find that, big exit or that unicorn if you're investing in small businesses. Same thing with stocks. If you're invested in 100% stocks, that's definitely going to be more volatile and more risky than 100% bonds, even though the last couple of years that hasn't been the case, but historically it has been. So all this to say, you should be compensated for the amount of risk you're taking on, and that's why you need to be cognizant of how you construct your portfolio, or if you look at it as a pie, you need to understand what slices and how big of a slice you want to allocate to certain things. So as always, thank you for watching and have a prosperous day. Actually, I'm going to end the note on saying WhiteBoard Finance University is ready to be rolling here in the next month or so. I know it's been a work in progress, but we figured out the tech stack. I have a landing page that's built. All the graphic design work is in progress, and we just need to upload some of the initial videos that are in the school. So if you guys don't know about WhiteBoard Finance University, it's basically just a gym membership for financial education. It's just a monthly fee. You get access to me via live streams every week. You get access to 3 different professors. One is a person who owns 400 single-family units. He's the real estate professor. We have a personal finance blogger who's written for all the biggest blogs out there, Investopedia, NerdWallet, all of them. And then also we have the a chartered financial analyst, which is a prestigious designation in terms of stocks and equities. It's actually a very hard designation to get. It takes a number of years. He is the stock market mentor, if you will, or professor. And you have access to all these people all throughout the membership. So hopefully that piques your interest. If you want to sign up, check out the sign up page below. That will be live in about a month or so. Thank you so much, everybody, and have a prosperous day. Okay, so I'm not going to end the video on anything funny, but if someone gave you $1 million right now and you had to pick one of these portfolios, which one are you sticking your $1 million in? You cannot touch it, and it has to be in there for 15 years. So we're not going to go short term. We're not going to go multi-decade. We're going to go 15 years. Which one of these portfolios would you pick?